in which we are discussing all the units from all the modules. And we have already completed the module A, B, C, and D. And today we are starting with the additional reading material on home loans, which we treat as the module E. All right. So all of the previous videos are already there on the YouTube channel. Make sure that you watch them. And also don't forget to subscribe to the channel so that you do not miss any of the updates. So we are starting with the module E, unit 27, which is the lender's appraisal procedure. So when the banks are giving out home loans to their customers, they need to keep certain things in mind. What are the lending principles and procedures, the contents of an application form and the documents to be submitted for availing the loan, the pre-sanction and the post-sanction procedures, appraisal of the loan request, documentation involved, monitoring of the loan account, detection of forged and fabricated title deeds, and the closure of a loan account on or due to the home loan frauds, etc. Right? So that is what is covered in this particular unit. So let us start now. So when we are talking about the lender's appraisal process, it starts with an application form. An application form is designed to collect all the relevant information that a lender needs to decide whether prima facie the loan exposure would be an acceptable risk and falls within the policy parameters of the bank. So, in the application form, the particulars that banks need to gather, the land and the building, the existing income and the source of it, how long this income is expected to continue in case of the applicant or let's say the co-applicant, what is the existing liability, any monthly financial repayment obligation on the proposed loans, among the other things. So this is what the banks will check in the application form. Then next step will be the documents that need to be submitted. The documents that need to be submitted for availing a home loan, right? Like the duly completed application form, passport size photograph, then the proof of identity like the voter ID, passport, driving license, the OVD, PAN and the Aadhaar card, proof of residence. If a non-salaried individual, then the proof of business and so on. So these documents will be collected by the bank and the branch should also send the title deeds in respect of the land and the building, which is given as the security interest to the panel lawyer for furnishing his opinion, right? So they should process the legal opinion and the branch needs to get convinced that the applicant actually holds clear, absolute and marketable title on the property that they have provided as security. Because for a home loan, the mortgage will be created. Then the valuation report on the property will be created. The land needs to be valued by the bank approved valuer. Then the valuer, they also need to comment as to whether the construction can be carried out in the plot as per the construction plan that is submitted by the applicant or not. The land is normally identified by its boundaries, right? So all of these things will be verified. So the branch will ensure that the construction has been approved by the local authorities, tax has been paid up to date on the land and the building, age of the building is ascertained, future life estimated, and RERA approval is applicable. All right, so this will be the preliminary steps. Then it is quite common that the housing loan application, particularly for the non-resident Indian who is not available in station, is received by banks through their agents. So when the application is received through that agent, banks for this purpose execute a power or the applicant executes the power of the attorney in favor of the agent. So the scrutiny of the power of attorney is also important. So the power of attorney is any authority which is given in writing to another person to act for and on behalf of the person who has executed the power of attorney, right? So they can act as an agent and apply for the loan. Then the acceptance of power of attorney for creation of mortgage is to be verified when both the principal and the agent are residing in the same place. Then the power of attorney may not be required except in case of the property developers. So there are certain specific points and provisions for the power of attorney as well. Then next step will be the appraisal of the loan request, the loan housing loan application, the appraisal form, guarantee agreement if required, arrangement letter. If the equitable mortgage is created, then we are going to confirm it by the confirmation letter, letter of undertaking, and everything. So we are going to see the eligibility. The lender could have a policy laying down the criteria for acceptance of a home loan, like a preferred age group or a minimum salary or income group, score in the credit information report or the areas or locality where the home loan will be given, and the negative list containing other disqualifications can be done. So here certain parameters that the banks they take into consideration while deciding the credit standards is given, like the loan amount requested, the cost of purchase or construction or renovation, the amount under the cost of purchase less the margin stipulated. Parameter 2 can be the gross monthly income of the applicant, co-applicant, then net monthly income of the applicant and the co-applicant. Finally, the total will be calculated. Then on the basis of that, the eligible loan limit can be calculated, right? The legal opinion, the age eligibility, valuation details, all of these things will be done. So making use of all the parameters, the typical format that is used by the banks is created. So for, let's say, it is a loan for construction of the house. So the area of plot, the proposed build up area, the purchase price of the plot. If, let's say, it is a case of flat, so the area of the undivided share of land, the cost of semi-finished flat, the total cost as well as the market value. If, let's say, the loan is for the purchase of house or flat which is ready built, then age of the existing structure if it is old, purchase price, cost of additional terms, and so on. So the banks are going to consider all of these parameters. Then obviously other factors will also be done, like the interest, how much will be charged, insurance, should the house should be insured against the risk of fire, earthquake, floods, etc. for the replacement value. Moratorium period is undertaken, the EMIs are decided, the EMI reset, documentation, all of these things are done. Now we come to a very important part, which is mortgage. You already know that when the borrower is giving a immovable property as security against the loan, then it is known as mortgage. So mortgage is the transfer of an interest in the specific immovable property for the purpose of security, for the payment of money advanced or to be advanced by a way of loan, and the security is created for when, let's say, the borrower they default in their payment, the secured creditor can then take resort to the mortgaged property. Now in India, the immovable property is accepted by the banks, usually by the way of either registered or simple mortgage or mortgage by the deposit of title deeds. There are many types of mortgages: the simple mortgage, usufructuary mortgage, English mortgage, deposit of title deeds, equitable mortgage. All of these are there. But we are going to study about the simple and the mortgage by deposit of title deeds. So simple registered mortgage is where, without delivering possession of the mortgaged property, the mortgager binds himself personally to pay the mortgage money, and that if in the event of his failing to pay, then the mortgagee shall have the right to cause the mortgaged property to be sold. So when we are talking about the borrower and the bank, so the borrower becomes the mortgager, mortgager, and the bank becomes the mortgagee, right? And the property, let's say a house is mortgaged by the borrower, then they need not give possession to the bank right away. They can still hold the possession, and if they default, then the bank will have the right to sell off the mortgaged property in the payment of the mortgage money, and the transaction is called the simple registered mortgage. Again, the deed of the mortgage is required to be registered with the concerned registrar, right? And registration charges should be paid. And in this type of mortgage, the property can be sold only with the intervention of the court, right? So registration is important. All right. Second type of mortgage is the mortgage by the transfer or the deposit of title deeds or equitable mortgage. So what happens here in particular towns, namely Kolkata, Chennai, and Mumbai, and any other town which is specified by the state government, by notification, they have to provide that the person they are delivering to a creditor or his agent the documents of the title of immovable property. So now the property itself should not be present in the same area, only the titles are being delivered. So there must be a debt existing or future, there must be a deposit of the accounts of title to the immovable property, and it must be in the notified towns. All right. Then there are the right to foreclosure, the priority of charge that is created. Now, when an immovable property is, let's say, uh, mortgaged or it is taken by security, either by the way of registered mortgage or equitable mortgage, certain things need to be looked into, like what is the tenure of the land, the valuation of the land, and the title of the land. It is necessary to ascertain whether the tenure of the land is of freehold, it is held on lease or statehold. Then the valuation of the land should also be done, determine whether the price paid for the land is in line with the prevailing prices or not. So the market price should be ascertained, and title of the property, that the borrower actually holds the land in lawful terms. Copies of the title deeds are not documents of the title. All right. So this is there. Now, when we talk about the registration of charges, then it is to be done with the CERSAI, the Central Registry of Securitization Asset, Reconstruction and Security Interest of India. This has been created under the SARFAESI Act. The SARFAESI Act, where the banks they can go for the reconstruction and securitization of the security asset that has been kept with them by the borrower, and it is required that they register the charge that is created with the CERSAI. So the object of CERSAI is to maintain and operate a registration system for the purpose of registration of transactions of securitization, asset reconstruction of financial assets, and creation of security. So this is given under the SARFAESI Act. You need not worry about the SARFAESI Act. Only you need to remember is that CERSAI is created for the registration of charges. Why? For example, the borrower has availed the loan from bank A, keeping their house on mortgage, right? Then the borrower has also borrowed a loan, taken a loan from bank B on the same house. They have kept it as mortgage. Again from bank C, and they have kept it as mortgage. The same house or the same immovable property. Now, if the borrower defaults, which of these three banks are going to have the right over the immovable property to get it sold in the market and recover their dues. This will depend on who of the three have gotten the charge registered first with CERSAI. So if let's say bank had given the loan, bank A had given the loan, but they had not registered the charge. Bank B had given the loan and they have registered the charge with CERSAI, and Bank C, they have not checked on the CERSAI site that whether it is unencumbered or not, and they have also given out the loan, right? And they have also created a charge. So when the property will be sold in the market under the SARFAESI Act, the first priority of payment will be given to the secured creditor who has first gotten the charge registered, which is the bank B, which is the bank B. So although Bank A had given the loan, let's say in 2016, Bank B had given the loan in, let's say, 2018, then also the priority of payment will first come to the secured creditor who has first gotten the charge registered. This is the priority of payment. That is why it is important to get the charge registered. So when a mortgager creates more than one equitable mortgage over the same property in favor of two financing institutions, the institution in whose favor the mortgage is created first has the priority of charge. This is the whole purpose of the priority. Today we'll be discussing the Unit 28 from Module E, which is the additional reading material on home loans. And this unit is housing finance and tax planning. So all of these videos are very important for your preparation. Make sure that you do not miss any of them. If you haven't seen the previous videos, they're there on the YouTube channel, so make sure that you watch them. Now, when we talk about the tax benefits in respect of housing finance, over the years, announcements have been made in the union budgets for the tax concessions, waivers, etc. And these are basically to encourage the housing and housing finance so as to counter the shortage of houses in India. So we'll be discussing the benefits available and the use of the benefits to reduce one's tax liability. So let us start. So in respect of loan that is taken or availed by the customer for the purchase, construction, repairs of a residential unit. We have discussed about the different types of loans, right? Home loans we have for the purchase of a plot as well, on which the construction will take place, a ready-made house, a flat, renovation, repairs, house decoration as well. So the borrower can avail benefit of payment of interest as well as repayment of the principal, right? So the interest and the principal, certain deductions can be made. So what are the home loan benefits? These are the tax deduction on the payment of home loan interest under section 24 of the Tax Act of the Income Tax Act of 1961, right? So we will write it IT Act of 1961 so that you remember. Then the tax deduction on the principal repayment of housing loan under section 80C of the Act, and the tax deduction for the first time buyer under section 80EE. RBI has also allowed housing loans for second house or second housing. But for the first time buyer also, there are certain additional tax deductions. So it is very important that you remember these sections. Section 24 is for the deduction on loan interest, section 80C on the principal repayment, and section 80EE on the first time home buyer. Now let us discuss in detail these different sections. So first we have the section 24B. This is the section 24B of our Income Tax Act. It says that the interest on housing loan can be claimed as a deduction from the income from property, salary, business or profession, capital gains or any other source. But here what you need to remember is that a maximum limit has been set of rupees 2 lakhs under the section 24B of the Income Tax Act. Right? So interest on the housing loan can be claimed as a deduction from the income on any of the property, salary, business, but a limit is up to rupees 2 lakhs. And then there are certain conditions that need to be fulfilled, that the loan has been taken on or after 1st of April 1999. Then the loan is for the purchase or construction of a residential property or refinance, right? Then the lender issues a certificate at the end of the financial year mentioning that there what is the interest and the principal that is paid during the year, and the interest payment of the home loan that is taken for a self-occupied property as well. All right. So this is there. Now this is for the construction or the purchase of a new house. If let's say the loan is availed for the repair or renewal, then the amount of only 30,000 is allowed under the section 24B. Right? Then the limit is 30,000. If it is self-occupied, rented or deemed to be rented, there is no maximum limit for the tax deduction. And the tax benefit under section 24, all of these things are given, right? So there are certain conditions. Then we have the tax benefit on home loan principal repayment under section 80C, which is 1,50,000. The maximum tax deduction under section 80C is 1,50,000, and it can be availed for both self-occupied and let out properties that are given out on rent up to a maximum of rupees 1.5 lakh every year from the taxable income of the assessee on the principal repayment. So if the principal repayment has been made by the assessee, then this tax reduction of 1.5 lakh every year can be done. And it is also part of the various deductions allowed, like the investment in PPF account, the tax saving fixed deposit, the life insurance premium, NSC, Senior Citizen Savings Scheme, and so on. So it is inclusive of all of these options. So this is another very important point. The deduction limit of 1.5 lakh under section 80C is inclusive of all the other options. Then there are certain conditions. Only if the construction of property is complete and a completion certificate has been received. If it was under construction, then no deduction will be allowed. Also available when the property is self-occupied or let out. There's also reversal. If we talk about the reversal of tax benefit availed under section 80C. So if a house property for which the tax benefit was availed is sold within a period of 5 years. So if you sell your house property within a period of 5 years, then the tax benefit will not be eligible for claim in that financial year. Right? So if it is sold within a period of 5 years from the end of the financial year in which the property has been received, then it will not be eligible for claim. Right? Now, how can you compute the income for the self-occupied property? In the case of self-occupied property will be either nil if there is no interest on housing loan, or negative to the extent of interest on the housing loan. And the deduction cannot exceed rupees 2 lakhs or 30,000 if it is related to a renewal or it is a new property. Right? So this is how the computation of income from the self-occupied property can be done. This table is given. Then we have the reversal. We have already discussed the reversal of tax benefits if it is sold within a period of 5 years from the end of the financial year in which the property has been received in possession. Then benefit under 80C will not be eligible for claim, and the total amount of tax that has already been claimed in respect of the earlier year shall be deemed to be of income of such year in which the property was sold, and it will be liable to pay tax on that income. Alright, so if you sell off your property within 5 years, then the reversal of the tax benefits under section 80C will be done. Then we have the third section, section 80EE, which is deduction available for the first time home buyers. The first time home buyers. So just like the deduction under section 24B, the section double E is also available to on the interest paid on the home loan by the taxpayer or the assessee, the interest that they pay. But it is only available to the first time home buyers. This is the most important point. The quantum of deduction is rupees 50,000 for the interest paid, and the deduction is available over and above the section 24 and section 80C. So it is exclusive over and above. So whether you have availed your deduction under section 24 of rupees 2 lakhs and in section 80C of rupees 1.5 lakhs, then over and above you will also have this deduction if you are a first time home buyer. Again, certain conditions. The deduction can be availed in the financial year from 1st April to 31st March. Value of the property should be less than rupees 50 lakh. Home loan should not exceed rupees 35 lakhs. These are certain conditions. Eligibility is also there. Then how can you compute the total income, the computation of the reasonable expected rent, what all will be included in it. So the municipal value of the property, fair rent of the property, and the standard rent as well. Then how can we compute the actual rent of the property? These topics are important. So make sure that you study these topics in detail. And we are covering all the units module wise from this paper. And today we have the unit 29 from module E, which is mortgage advice. So we are studying the additional reading material on home loans. We have studied the different types of mortgage. Now, how can we calculate the various rates when deciding on mortgage or not? Or mortgage advice profession if we are talking about. So in India, the mortgage advice profession is carried out without any regulations. There is no entry barrier and no code of conduct or ethics that are stipulated by any regulation. So any person can enter the profession and provide advice and do business, right? Now, if we talk about how can then we decide from where should we take the advice or which advice would be correct in terms of mortgage or not, what is the role of the mortgage broker, all of these things become important. Okay, so one such important thing is the home information pack, which contains the important information that the buyers and sellers need to know, and it has been implemented in UK under the home information packs, which includes the energy information certificates, which is implemented on a phased basis from 1st August 2007 in UK. And from then on, the packs will be required for the sale of 4-bedroom properties, smaller properties, and so on. So basically, this idea is something which can be used by the Indian brokers as well, as to give a more clearer idea. But now when we are talking about this particular unit, we will focus on the different uh, numericals that can be asked or certain formulas that can be important in terms of mortgage. So first we have the time value of money, interest and annuity. What is meant by the time value? A rupee today is worth more than a rupee tomorrow. A rupee today is worth more than a rupee tomorrow. This means that we need a realistic appraisal for the cash payment or receipt, and it must be related to the time when the payment takes place. In particular, it must be recognized that rupee 1 which is received today is much worth more than rupee 1 which is receivable at some future date. So to illustrate this, if let's say rupees 100 was invested today at 5% per annum compound interest, it would accumulate to rupees 105 at the end of 1 year, then 110.25 at the end of 2 years, and so on. In other words, we can say that 110.25 receivable in 2 years' time is worth only 100 rupees today if 5% per annum can be earned in the meantime. So this is the whole concept of value of time value of money. So how can we convert the future sums into their present equivalents? This is known as discounting. Discounting, the discounted value or discounting, which is simply the opposite of compounding. Compounding, we are finding out the interest for the future or the value for the future. If we want to convert the future sums into their present equivalents, then we can do so by compounding. So present to the future, compounding, and future to the present, discounting. All right. So frequently compounding of interest. What if the interest is paid more frequently? Then what we can do, we can simply use the formula annually P multiplied by 1 plus R, or we can say annual compounding. This is the annual compounding. For quarterly, it is known as quarterly compounding, and monthly, it is known as monthly compounding. So the final principal after T is equal to 1 year on an account initially with the principal 10,000 at 6%. So we are saying that the principal is 10,000 and a 6% interest rate is there. Compounding interest. So if we go on compounding for the years, yearly, semi-annually, quarterly, monthly and weekly, these will be our results. We can simply calculate the compound interest, and yearly, semi-annually, quarterly, we can do so. Right? So this is the time value of money. Under this, we have three important rules: the rule of 72, rule of 115, and rule of 144. These are the three important rules that determine the number of years before your money becomes almost double, triple, and 4 times of the principal, whether in debt or in investment. Alright. For illustration, let's say we borrowed a sum of 1,000 rupees at 6% interest. We will just write it down, a sum of rupees 1,000, and the interest rate is 6%. Right? Now, if we divide, let's say 72, if we are following the rule 72, so we will divide 72 by 6, 72 divided by 6, which will give us 12. So it makes 12 the number of years it would take for your debt to double to 2,000 rupees. Right? This is how it is done. If let's say there's a savings account with 500 rupees deposited and the interest rate is 4%, interest rate is 4%, then we are going to divide 72 by 4, which will give us 18, and 18 is the number of years which will take 500 rupees to almost double. Similarly, if we divide, let's say any other number we can take. If we take the rule of, now we'll take the example of 115, the rule of 115. Similarly, we can divide 115 by 4, which will give us the years, 28 years and 9 months. But this will now show us the time that will take our amount of 500 to triple. Right? To triple. And if we use the rule 144, then it is going to show us how much time will it take for the initial principal to become almost 4 times. Almost 4 times. So simply we are using the rule 72 to see in how many years our amount will double. We are using a rule 115 to see in how many years it will triple, and 144 to see in how many years it will become 4 times. Simply we will divide the number, the rule, by the given interest rate, and we can easily calculate the number of years. Alright. Then let's say we want to calculate the future value of money. The future value of money. So the formula which is used is future value is equal to present value multiplied by 1 plus r raised to power n, where r is the rate of interest and n means the period of term. For example, if rupees 1 lakh is invested for a period of 5 years, so the present value is rupees 1 lakh. The rate of interest is at 10% and the period or n is 5 years. So how can we calculate the maturity sum? We will simply put these values in the formula. So the FV is equal to 1 lakh, multiply it by 1 plus our interest rate. If we convert into the decimal point, it is 10%, so 0.10 raised to power 5, and it will give us the value. Right? So this is how we calculate the future value of money. And the same value can also be calculated by using the future value table. The future value here will be the present value multiplied by the future value factor, which is the future value factor of rupee 1 at different rate of interest. The table can be given us like what is the value of rupee 1 at 7%, 8%, 9%, and simply using the calculator we can calculate the future value. Alright, so you can take many examples to calculate simply seeing the table, which makes our calculations even easier. All right. So this we have seen the calculating of the future value. Now, what about the future value of the annuity? So the calculating the future value of an ordinary annuity. Annuity is something, let's say you purchase a pension plan or an insurance plan on which annuity is paid to you for a certain time period. That is annuity. So if you know how much you can invest per period for a certain time period, the future value of the ordinary annuity formula is useful for finding out how much you would make in future by investing at your given interest rate. So if you are making payments on a loan, the future value is useful for determining the total cost of the loan. And how can we calculate the future value in case of annuity? So this is the formula. This is the formula for calculating the future value of ordinary annuity, where F is the future value of the annuity, A is the annuity, I is the interest rate, and N again is the term. N is the term. Right? And similarly, we can also calculate the future value of annuity on an annuity date. In this formula, which is given for the ordinary annuity, we will simply multiply it by 1 plus r. So this will give us the calculating of future value of an annuity date. For example, let's say we take the same example that we had taken earlier, the value, the future value of annuity due of rupees 1000. We need to calculate the amount due, which is rupees 1000 for a period of n, let's say 5 years, and the rate of interest would be 5%. So if we put all of these values in the formula which is given, so 1000 multiplied by 1 plus it is 5, so we will take the decimal 0.05 raised to power 5, which is the number of years, minus 1, and divide this value by I, which is our rate of interest, again 0.05. And because we are calculating for the annuity date here, so we will multiply it by 1 plus 0.05. This will be the formula. So these formulas are very simple. All you need to do is put the values in the formula, and using the calculator you can calculate the different values. Or Another way can be using the compound value factor for annuity. Again, the different values will be given at 7%, 8%, 9%, which is again an easier method. So the future value of annuity can be calculated by annuity, which is the present annuity, multiplying it by the CV factor, the compound value factor. All right. So simply from the table also we can convert it. Now, the other topics which are covered under this chapter are like capital gains, which we have discussed earlier also, which is any profit or gain from a transfer of capital asset, right? Again, the capital asset can be any property, movable or immovable. We have also studied about the short-term capital gains. If it is less than 36 months, a capital asset has been held for less than 36 months, and long-term capital gains are also there, all right, which is more than that. So, another important formula which is given is the cost inflation index. Indexation, when we talk the cost inflation index, it is a process by which the cost of acquisition is adjusted against the inflationary rise. In the future, the prices might rise, so we take into account the inflationary pressures. So, for this purpose, the central government has notified the cost inflation index, and what we can do is the benefit, it is available only to the long term capital assets, so we can compute the indexed cost, right? So the cost inflation index is given starting from the financial year, and the cost inflation index which can be used, and the formula to compute for the computation of the index cost, it is the cost of acquisition multiplied by the cost of inflation index of the year of transfer of capital asset. The cost of acquisition, whatever money you have paid, multiply it by the cost of inflation index of the year of the transfer of the capital asset, and divided by the cost inflation index of the year acquisition, right? If, on the other hand, we are talking about the cost of improvement, then other things remain the same. Simply, the denominator changes to the cost inflation index of the year of improvement. The year of improvement, right? Then there are certain exemptions which are made, when and to what extent the exemption is there from the tax, the long-term capital gain and the short-term capital gain, which can also be ascertained. Series for May 2025, and in this series we are covering the RBWM paper, all the units module wise, and today we'll be covering the unit 30 from module E, which is the valuation of real property. Module E is all about the additional reading material on home loans, so we'll be talking about what is valuation of the property and who does the valuation, what are the sinking fund, what is the meaning of the reverse mortgage, the types of real property, all of these things. All right. So when we are talking about valuation of real property can be agricultural land, right? Real property can also be the urban land, or the land with building can be another category. So, valuation basically means the assessment of the worth of the asset or property. We are valuing the property. The worth or the value is based on the income and other advantages that will occur from the property in the future, right? So it is distinct from cost. Cost means the actual amount which is spent in producing the asset. Price is the cost of production plus the profit of the producer. So it is going to depend on the demand as well as the supply. Thus, cost is not the same as value and price is not necessarily equal to value. So we need to do the valuation. Thus, valuation is a specialized area which is practiced by the qualified engineers and architects who possess the knowledge of building costs, awareness of market conditions and economic trends, development plans, legal statutes, provisions, rental incomes, etc. So the value of the property does not equal to the cost or the price of the property. We do the valuation taking into account all of these factors. The valuer will be required to collect data on these aspects about the demand and supply. They need to rely on their own experience as well as on their judgment to arrive at the fair market value, right? So there are classified valuers under the Wealth Tax Act. The Income Tax Department grants registration to the valuers of the Wealth Tax Act on the basis of the technical background and experience. So we have separate categories like immovable property, agriculture, land, plant and machinery, and jewelry, etc. All right. So we have the institution of valuers, the institution of valuers at Delhi, which is a professional body which grants the membership to the practicing valuers. There are several banks and financial institutions which also require, besides registration under the Wealth Tax Act, the membership or fellowship of the institution as well. All right. So, according to the type of the real property, the valuers are going to conduct the valuation. For example, if we are talking about the agricultural land, so the factors which are going to influence are the location, the soil quality, availability of water and electricity, size of holding, clear title of land, access by road, cottage or farmhouse, the types of crops that can be cultivated, and the valuation of agriculture land can be done by two methods. We have the income capitalization method and the sales statistic method. In the income capitalization, the income is determined by assuming that the land is rented on the crop sharing basis. Then the net annual income is arrived after deducting the expenses which are incurred, like the local taxes, the cost of maintenance, the cost of inputs, insurance. All right. So the capitalized value means the amount of money which is required today to get a certain fixed income in the form of annual installments over a very long time, which is also known as the perpetuity. Right? Second method is the sales statistics method. Valuation is based on the comparable sale value of the similar agricultural land located in the vicinity. If a similar land having the same or similar factors located in the vicinity has been sold, then we are going to compare the value. So the factors for comparison can be the size of holding, the physical features, roads, fencing, the title of the land, condition of letting out for cultivation, and so on. So this was regarding the agriculture land. Then we also have the urban land, the lands which could be put to residential or industrial use, and their value depends on their potential for development through the construction of the appropriate structures. So the location, size, usage, the restrictions on development by any authority, return frontage, all are important. So there are certain methods which can be used for the valuation of open land. We have the comparative method, which is the most popular one. Here, the value is determined on the basis of the fair rate for land situated in the vicinity. We are comparing the land which was very recently sold off, very recent sale purchase transactions are there. We can compare it. So the valuer has to draw on their own experience as the land rates are as per the deeds. All right. Then we have the rent capitalization method. Again, the comparable property in the recent or the nearby area is used as the benchmark, and then the replacement cost of the building is worked out. Then we have the belting method, taking into account the frontage and the depth of the land. It is adopted for the big size plots that have lesser frontage and more depth, right? And then we have the extraction method, where the unit prices for the comparable land are extracted from a developed property in the vicinity. Then the value can be adjusted for any difference in size, shape, or location and other features, right? So these are the methods for the open land. Then we also have the land with building. Again, the same methods can be used. The comparative method, rent capitalization, valuation can also be done on the base of profit or on base of cost as well. So these methods will be used. Next, we have the concept of sinking fund. Sinking fund, let's say at the end of the life of the structure, that is when it ceases to yield the desired income, a property has to be replaced or rebuilt so that the income may continue for a further period. The fund that is set aside for this purpose for recovering the original capital is known as the sinking fund. The fund that we will require to restructure or rebuild is the sinking fund, right? So the amount to be regularly set out of the annual income to create the sinking fund, it is going to depend upon the compound interest it is supposed to earn over the life of the structure. For example, the factor of redemption of rupee 1 at the end of 25 years at 5%, compound interest is 0.021. Thus, the sinking fund for the redeeming of the original capital of, let's say, rupees 15 lakhs, we can simply multiply it by 0.021, 0.021, and we can arrive at the value. Right? We will multiply 15 lakhs by 0.021 and the value will be as per the calculations. All right. Then another concept is depreciation, which refers to the loss in the value due to the wear and tear or the result of usage. So it is the deterioration in the physical condition. Wear and tear, effect of climate conditions, poor structural design or workmanship. We can also calculate the annual depreciation using the formula C minus S divided by N, where C is the original cost, S is the salvage value, value that the property may fetch at the end of the useful life, and N is the life of the building in years. So we can calculate the depreciation as well. Then we have the concept of reverse mortgage. There's a difference between the general mortgage and the reverse mortgage. In a normal housing loan where the property being purchased is mortgaged to the lender, the borrower avails a loan to begin with, and at that point of time his stake in the property purchased is very low. This is the normal condition. The stake in the property is very low. Then as the regular EMIs are paid, the loan amount reduces and his stake in the property increases. As the borrower, they keep on paying the loan amount, their stake holding in the property increases. However, reverse mortgage situation is completely the opposite. It is exactly the reverse. Here, under the reverse mortgage, the borrower initially retains a high stake in his property and receives a regular cash flow. Over the time, when the loan amount increases, then his stake in the property reduces. So it is completely opposite of the general mortgage, right? So this is the difference between them. There are certain salient features under the reverse mortgage loan scheme, which was introduced in 2007. So many banks, they have issued guidelines under the reverse mortgage, which is developed by the National Housing Bank to help the senior citizens so that they can avail the periodical payments and so on. All right. So there are features that are beneficial. Then how can we calculate the periodic payments under the reverse mortgage? We can do so by using the periodic payments as available in the website of the NHB. So this is the formula for that. PV, which is the property value, multiplied by the LTVR, which is the loan to value ratio. The number of installments is N and I is the value, which will depend on the disbursement frequency, which is selected by the borrower. All right. So this is the formula to calculate the periodic payments under the RML. The salient features are important of the reverse mortgage loan scheme. If there's any transfer of capital, the maximum period of the loan is 20 years, or the loan amount may be used for the varied purposes. So all of these features are important, and with this